Today, the trade desk stock had a very strong day in the market. Shares of the trade desk, ticker symbol TTD, surged about 18% on Thursday, March 5th, reaching roughly $29.70 per share. This was actually one of the biggest moves in the entire S&P 500 today, making the trade desk the top gainer of the day. The rally is especially notable because the stock has struggled over the past year. Even after today's big jump, TTD is still down more than 55% compared to where it traded a year ago. So today's surge represents a significant shift in investor sentiment after a long period of decline. Before we talk about why the stock jumped today, let's quickly review what this company actually does. The Trade Desk is a digital advertising technology company. It operates a demand-side platform, which allows advertisers and agencies to buy digital advertising across the internet in an automated way. Instead of negotiating ad placements manually, advertisers can use the Trade Desk platform to run highly targeted ad campaigns across multiple channels, including websites, mobile apps, streaming TV platforms, and retail media networks. One of the fastest growing areas for the Trade Desk is connected TV advertising, which refers to ads shown on streaming platforms like smart TVs and streaming devices. As more viewers shift away from traditional cable TV to streaming services, advertisers are increasingly moving their budgets to these platforms, and the Trade Desk plays an important role in facilitating those ad purchases. Now, let's talk about why the stock surged today. There were actually two major developments that boosted investor confidence. The first catalyst was a potential partnership with OpenAI. According to reports from The Information, the Trade Desk is currently in early discussions with OpenAI to help manage advertising sales for OpenAI's platforms. If this partnership materializes, it could be a very big deal. OpenAI's products have massive global user engagement, and being involved in monetizing that ecosystem would validate the Trade Desk technology and infrastructure in the rapidly growing AI-driven advertising space. The second catalyst is a massive insider purchase by the company's CEO, Jeff Green. Jeff Green revealed that he personally bought about 6 million shares of the Trade Desk between March 2nd and March 4th. The purchase was worth approximately $148 million. Large insider purchases like this often send a strong signal to the market. When a CEO invests that much personal capital into their own company's stock, investors tend to interpret it as a sign that leadership believes the stock is significantly undervalued. So when you combine the potential OpenAI partnership with a massive insider buy from the CEO, it's not surprising that investor sentiment improved dramatically today. Now, let's talk about the outlook for the Trade Desk going forward. The overall analyst view on TTD right now is somewhat mixed. There is still strong long-term optimism about the company's business model, but there are also concerns about short-term growth and the broader advertising market. Across more than 30 analysts covering the stock, the consensus rating is still generally a buy or moderate buy. However, the number of strong buy ratings has declined slightly in recent months. Price targets also vary widely. The average 12-month price target is around $51 per share, which would imply significant upside from current levels. The most bullish analysts have price targets as high as $115, while the most bearish estimates are as low as $17. Some analysts recently lowered their targets after the company issued weaker guidance for early 2026. For example, KeyBank reduced its target price to $35 while maintaining an overweight rating, and Piper Sandler lowered its target to $28 with neutral rating. Looking ahead, the bull case of the Trade Desk is driven by several potential growth catalysts. First, strategic partnerships such as a potential OpenAI collaboration and the company's expanding publisher partnerships could drive new revenue opportunities. Second, 2026 could benefit from several major global events that historically increase advertising spending, including the U.S. midterm elections and the FIFA World Cup. And third, the long-term shift toward connected TV and streaming advertising continues to be a major tailwind for the Trade Desk business. However, there are also some risks that investors are watching closely. The company's recent revenue guidance suggests growth could slow to around 10% in early 2026, which is significantly lower than the more than 20% growth rates the company achieved in previous years. Competition is also increasing from large tech platforms like Amazon and Google, which operate their own advertising ecosystems. In addition, analysts are watching for potential margin compression, with forecasts suggesting operating margins could decline by roughly 500 basis points year-over-year in early 2026. So overall, today's rally shows renewed investor optimism, but the long-term performance of the stock will likely depend on whether the trade desk can re-accelerate its growth and maintain its leadership in the open internet advertising ecosystem. Thank you so much for watching this video. If you found this breakdown helpful, please consider liking the video and subscribing to the channel for more stock analysis and market insights.